Dan Davis, and I'm joined with Sam Miller and Rich Kurowski, representing ADK Wealth Advisory Group. Today our purpose is to shed some light on our investment committee's global economic and financial market update. Best to start with a bit of a story. Recently, Mary Kay, my wife, and Sam Miller and I were traveling as we were enjoying the CMA Fest. And it was interesting because we were traveling through Nashville, and Mary Kay made a comment as we were using our GPS system that she really wished when we were in a city that we weren't familiar with, that she had the ability to see a map that kind of showed the whole area before we traveled through. And it kind of dawned on me that many of our clients could benefit from that same kind of financial map, because as you charter through the financial markets and you see all the news and the volatility, the Dow went up, the S&P went down, that kind of stuff, it creates almost the same experience like you're driving through an area that you're not sure what's going on. So what our intentions are through these financial market updates is to kind of provide you with our macro outlook to help you as you're traveling through your financial life to have a better understanding of what's going on. So I think it's good to talk for a second on what is our view. And if you take a look at a slide that all of us have talked about in other meetings, it's called Alternating Secular Bear and Bull Markets. It's good to know that economies and financial markets go through these long cycles, and sometimes they're good, like secular bull runs. You can see that on the chart in green. You'll also see that they transition typically due to excess, where the financial markets and economies get greed and over-optimism driving to levels where we then go through these extended secular bear periods. It's awkward because when you're going through these secular bear periods, they're all different. And sometimes what you'll find is that you'll have a financial meltdown, but before the problems that created it are done, the markets start climbing back up again. As you can see from the chart that talks about cyclical markets within a secular market. So it's a paradigm shift when you see the markets climbing, but yet the news around you really is not that good. You start to wonder, are things better than what we thought? So it's our strong opinion that the secular bear market that we're in started around the year 2000, but that we're experiencing a cyclical bull run right now that really is being driven by what I'll classify as quantitative easing. And quantitative easing is a really hyphen-angled word that is printing money. In the summer of 2012, the United States Federal Reserve has been printing about $85 billion of new money, and literally using this concept called an asset repurchase program, where they go in and buy debt and creating artificial demand that really stimulates the economy and things like the housing market by keeping interest rates artificially low. In the summer last year, you also saw Italy and Spain really flare up. There's a belief that the debt cost for those two countries, if it exceeds 7%, that the very weight of that debt alone will create those countries to collapse. So the ECB, the European Central Bank, last summer stepped in and intervened, because when those countries were refinancing maturing debt, the rate had actually jumped up into the sevens. They didn't actually do anything of significance other than make a statement that they said, we will do whatever it takes to keep the euro intact, even if it entails quantitative easing with an asset repurchase program. The interesting thing is I was at a research program by PIMCO not too long ago, and Europe's done none of that. They just made the announcement that they would. And from there you saw the financial markets start this cyclical run-up, where if you look at, say, mid-July where we sit today, the S&P 500 year-to-date's up over 15%. But that same kind of run-up hasn't been enjoyed all over the world. If you take a look at a lot of the European markets, they're up, but we're talking low single-digit returns. And the thing that's even more befuddling is if you go into the emerging markets, many of their equity markets are in negative returns for the year in their stocks. And it's our belief that what's going on there is you see that their economies are doing well, but they're not doing as well as what the globe expected them to be able to do. So you've seen capital markets shift where a lot of money has come to America as a result of that. And getting back to Europe, the thing that's interesting is if you take a look at the United States, about 50% of the jobs that people have are with small to mid-sized companies. That's even more robust in Europe, whereas in France, for example, 60% of the jobs are held by people who work for small and mid-sized companies. If you go to Spain, it's more like 65%. If you go to Italy, it's over 80%. Spain's economy is more than double the size of Portugal, Greece, Cyprus, and Ireland combined. And if you look at Italy, Italy's economy is more than 65% larger than Spain. So clearly the two linchpin countries of Europe making it or not making it are Italy and Spain. And so the quantitative easing that's going on in America, the announcement that they're willing to do that in Europe, has created an enormous run-up in the financial markets. Not to be outdone, Japan in the winter announced that it would do this. When you take a look at their financial markets year to date, they're up over 27%. Now, it's not all quantitative easing. There are some things that I think are really real, like, for example, the housing market. There's some things going on in the U.S. housing market that are very exciting, and I'd like Sam to weigh in on that.
5 years ago, the housing market was the match that united the global financial crisis. Let's look at how the market is improving and why this recovery has room to run. Nationally, home prices are up 10% over the last year. Foreclosures have dropped as unemployment decreases. We are experiencing a shortage of available real estate listings, and historically speaking, we are building less new homes, which equates to an increase in existing home prices. Also, mortgage rates will remain relatively low, which gives incentives for new home buyers and also for people looking to move. As I mentioned earlier, the housing market has the potential to create a chain reaction in the economy. This is called the economic multiplier effect, and now it is on our side. For every house built, approximately 3.5 jobs will be added. As home prices increase, so do home equity lines to remodel and add on, which also plays into the effect of the low mortgage rates. However, the wealth effect is probably the most important though. For most Americans, their biggest asset is their home. Higher home prices equal higher net worth, which equal higher consumer confidence, which equal higher consumer spending, and this circle will continue. The bottom line, analysts believe that over the next 5 years, housing will contribute 1% to the annual GDP growth, which is a large amount. The housing market is continuing to improve, and it will bring the economy with it.
So as we can see, housing is a driver that's a very real component of the economy right now, whereas the quantitative easing, in my view, is more artificial stimulus. When we kind of leave the intermediate term and current reality and we look long term, there's this concept of megatrends. Financial Advisors January magazine, using support information from Bloomberg News, talked to 4 megatrends that are actually occurring right now that they believe are changing the global balance of power, and that they're happening at such exponential speed that we've never seen this in all of mankind. Pretty fascinating. The National Intelligence Council produced a report, 140 pages, really digging deep into those 4 megatrends. First megatrend is the declining power global balance, if you will, of America. The second is a rising power of individuals and groups against states, not United States, but states' governments. And then a third is the rising middle class. And then the last is a Gordon knot around food, energy, and water. Let's kind of unpack those a little bit. So the first one is around America losing its singular global dominance. Let's focus just on China for a minute. If you go back to the 1790s to 1830, China's economy made up over a third of the global GDP. That's pretty staggering to think about in that period. Now, then you had a period of time around 1830 to 1850 where the West, driven by Great Britain, came in with military force and really made the East trade with the West. And this was the catalyst or the beginning over a very humiliating long period for China's decline. Whereas if you look at, say, 1960, China's GDP was less than 5% of global economic output. So from a third to something that's almost zero. Now, fast forward time, and you can see that China's economy is the second largest economy and continuing to grow. So as we start to take a look at America coming down and the East rising, we're in the department that believes that we're in for a period of continued Western decline. It's not that it's the fall of Rome or the collapse of America, but rather a unique situation where you go from one global power to more regional powers. China obviously being the one in the East. You'll also see India, Russia, and then some countries down south of us in Latin America like Brazil. There will be tension around that, and there will be even times where we wonder whether or not it's going to blow up in our face. But in the end, we believe it's just a balancing of power. Let's unpack the next one around the middle class. If you take a look at 1830, statistics show that on the face of the earth we had about 1 billion people. So it took a while to get there. Over the next 100 years we got to 2 billion. Fast forward to now we're over 7 billion. Approximately 1 billion of that is what's defined as middle class. By 2040 it's projected that we'll be at 9 billion. And the Financial Advisor magazine I alluded to earlier talks about how that middle class will double from 1 billion to 2 billion over the next 18 years. When you take a look at what that does to things like the fourth megatrend, which is the Gordon knot of food, water, energy, it's pretty astronomical. For example, when you take a look at water, as you start to see how little of the water that's available is really available for drinking, we're in the camp with many that believe that you're going to see regional conflict over the drinking water. So as we see the middle class burgeoning and going from 1 billion to 2 billion, it's easy to see how that combined with the global population going from 7 billion to 9 billion, how that puts a lot of demand pressure on limited supply, especially when it comes to drinking water and food and energy. Recently we did a tour at Monsanto's research labs located in Chesterfield, Missouri. And as you walk in over to the left, they've got a lobby area. And one of the things I thought was the neatest was they had this light globe. And in that globe, it showed some interesting statistics. One of which was that 79% of the globe is water. Much of it's not drinkable water. That leaves us with about 29% land, but only 3% of that land is farmable. So when you talk about food demands, middle class people want more food that's in the area of chicken and beef, which really puts a lot of demand pressure on grain and corn and such. The last, which is around energy, is probably the most exciting for Americans, and I'd like Rich to talk on that.
One of the biggest developing economic stories today is the U.S. energy boom. This is a story that would have been hard to imagine 10 years ago, or really even 5 years ago. A recent Wall Street Journal article stated that U.S. oil production in May of 2013 has exceeded net imports. Now this is the first time this has happened since the mid-1990s. The U.S. is right now the number 3 oil producing country in the world, behind Saudi Arabia and Russia. The International Energy Association predicts that by 2020 the U.S. will surpass both Saudi Arabia and Russia in oil production. By that time we'll be producing over 11 million barrels of oil per day, and IEA predicts that by 2035 the U.S. will be energy self-sufficient. That's a big story. Now the source of this energy boom is oil and natural gas deposits that are contained in shale rock formations throughout the center part of the U.S. These formations stretch from the Appalachians to the Rockies, starting up in New York State, down through Texas, and up along the Rockies Front Range through Wyoming, Montana, and into the Dakotas. Now, geologists have known about these deposits and these formations for a long time, but it's just been recently that the technology needed to extract these deposits has really made the development of these resources both technically and economically feasible. Two specific technologies that have been vastly improved in the last several years are directional drilling and a process called hydraulic fracturing or fracking, which allows extraction of these deposits. So what does this mean for the U.S. economy? Well, IHS Global Insights, an international energy consulting firm, recently predicted that just this energy production itself will result in 2.5 million new jobs in the next 10 years here in the U.S. and 3.5 million new jobs over the next 20 years. The American Chemistry Council, which is a chemical manufacturing industry group, predicts that in the next 5 years, the lower energy costs here in the U.S. will result in 1 million to close to 1.2 million new jobs in the chemical manufacturing industry here in the U.S. They also predict that this industry will add about $250 billion to production. That's 2% of U.S. GDP, so those are very big numbers just in the next 5 years. Natural gas exports should grow. Right now, the cost of natural gas in Europe is 3 times what it is here in the U.S. The cost of natural gas in Japan is 5 times what it is here in the U.S. So there's definitely incentives for U.S. manufacturers to export their product. There's definitely incentives for companies in both Europe and Japan to buy that product. So expect that to be a growth factor here in the U.S. economy. And of course, with that export industry will come infrastructure build and supporting industries also. Now, lower energy costs here in the U.S. may not be the deciding factor in U.S. manufacturers keeping their operations here in the U.S., but the Boston Consulting Group recently released a study showing that within the next 2 to 3 years, probably about 2015, that the cost differential between manufacturing overseas versus manufacturing here in the U.S. is going to be down to about 10 to 15%. Now add in the lower energy cost, and U.S. manufacturers are going to have a real reason to keep their operations here in the U.S., close to the U.S. market, and of course avoid a lot of the logistical challenges and quality challenges that they faced over the past several years. Now there's still questions, issues, and challenges around this energy boom and around the energy industry in general. These are being worked on, but there's no question that the opportunities for the U.S. economy for economic growth as a result of this energy boom are huge. Now, we'll be talking about more of these issues and more of these opportunities the next time.
So let's bring all this together. We talked at the beginning about wanting to have a map so that as you're sort of navigating through your financial life, that the information we're providing is helpful. So when I think in terms of our macro outlook for our investment committee, I think it's important to know that financial markets go through long cycles. We believe that we're in a secular bear market, and that right now the most recent run-up is driven by things like quantitative easing and housing, and that cyclical bull run-up, we don't believe that that's the beginning of the next secular bear. Rather, we think that we probably have some continuation of that run, assuming that one of 2 major risks of Europe or geopolitical risk doesn't blow up. We do believe, though, that when you get beyond, say, the 2013 period into that 2018 in that range, that we'll have another major market meltdown. Hard to say what the driver of that will be. But the good news is that we don't believe that we'll be in a situation where this goes on forever. We believe that the next secular bull run is around the bend, and that the mega trends that we talked about will be strong enough to push us into that. So, as many of you are clients of ADK Wealth Advisory Group, we'll take this information, answer any questions that you have in our follow-up meetings. We'll also make sure that we cover how this relates to your portfolio. We ask that if you've enjoyed this, that you would share it with your social network. And if you're not a client of ADK Wealth Advisory Group and you'd like to learn more about how we help with financial planning and what we do with risk management, simply visit our website at discoverindependence.com. With that said, we'd like to thank you for your time, your business, and have a blessed day.